May 5, 2026, Tuesday. Topic: Gold versus silver warning signal, the hidden financial shift no one is talking about. If you think today's financial system is stable, then this is exactly the kind of moment history later calls a silent warning phase, because what you are about to hear is not a prediction. It is a pattern already unfolding in real time inside gold and silver markets. And if you stay until the end, you will understand why smart money is quietly repositioning while the rest of the world is still distracted by headlines that don't tell the full story. It didn't start with a headline. It started with a movement most people completely ignored. On the surface, nothing looked unusual. Markets were open, charts were moving, and financial news was repeating the same stable economy narrative. But underneath that surface, something was quietly shifting. Gold was not behaving like it normally does. Silver wasn't following its usual rhythm. And for those who were paying close attention, it felt like the financial system was whispering a warning that most people were not trained to hear. This is not about panic. This is about patterns. And right now, the pattern is getting louder. Because when gold starts rising without clear external shocks, and silver begins to move with unusual volatility, history shows us something important. The system is under internal pressure. Not visible pressure, but structural pressure. The kind that builds slowly inside debt cycles, banking liquidity conditions, and currency confidence. And what makes this moment different is not just the movement itself, but the context around it. Inflation is not fully cooled, debt is still expanding, and central banks are no longer in a position where they can freely fix every imbalance without creating a new one somewhere else. This is exactly the kind of environment where precious metals stop behaving like investments and start behaving like signals. Gold becomes the quiet indicator of trust in the system. Silver becomes the more aggressive reflection of both industrial demand stress and speculative positioning. And when both start to diverge from traditional market expectations, it usually means investors, especially large institutional players, are repositioning long before the public narrative catches up. That gap between perception and positioning is where the real story begins. If you look back at previous financial stress cycles, you'll notice something uncomfortable. Before the major headlines arrive, before the panic becomes visible, before retail investors even realize something is wrong, gold moves first. It doesn't crash. It doesn't explode. It simply begins to trend in a direction that contradicts confidence-based markets. Silver then follows with sharper volatility, almost like it is reacting to pressure building beneath industrial and monetary layers at the same time. That sequence has repeated before, and right now, early fragments of that same structure are appearing again. And what makes this moment even more unusual is the silence surrounding it. Because while gold and silver are beginning to move in ways that don't fully match traditional economic expectations, most mainstream narratives are still focused on short-term distractions, interest rate speculation, tech stock momentum, and political noise that changes every week. But beneath that surface-level attention, institutional positioning is already shifting. Large funds and central actors don't move loudly. They move gradually, quietly, and early, long before retail sentiment even realizes something has changed. If you zoom out and look at the bigger structure, the global economy is sitting on layers of unresolved pressure. Debt levels did not disappear after rate hikes. They adapted. Banking systems did not fully reset after recent stress episodes. They adjusted their risk exposure. And liquidity, which is the invisible fuel of every financial cycle, is still unevenly distributed across markets. In environments like this, precious metals often begin to behave less like commodities and more like mirrors, reflecting confidence, fear, and imbalance all at once. This is why analysts who pay attention to macro signals are not just looking at price direction. They are watching relationships. The gold to silver ratio, for example, is not just a number. It is a reflection of how the market is balancing safety versus industrial demand stress. When that relationship starts to shift in unusual ways, it often signals that underlying expectations about growth, inflation, and liquidity are being recalibrated in real time before official data ever confirms it. At the same time, central bank behavior adds another layer to this story. Over the past several years, there has been a consistent trend of increasing gold accumulation across multiple countries. Not for speculation, not for yield, but for reserve diversification and long-term stability outside of traditional currency dependence. When institutions with the most information in the system begin to increase exposure to non-yielding assets, it raises an important question. What kind of risk are they preparing for that is not yet visible to the public? And perhaps the most important part of this entire setup is the disconnect between perception and positioning. On one side, everyday market commentary still frames conditions as manageable or normalizing. On the other side, deeper capital flows are adjusting quietly, building hedges, reducing exposure, and preparing for a range of outcomes rather than a single optimistic path. This gap doesn't always close smoothly. In many historical cycles, it closes abruptly, when price movement finally forces perception to catch up with reality. And when that moment of alignment finally comes, When perception catches up with positioning, it rarely feels gradual. It feels sudden. Prices move faster than expected. Volatility spikes in places that were previously calm, and assets that were ignored for months suddenly become the center of attention overnight. This is where gold and silver can shift from being quiet signals to becoming dominant narratives, pulling in momentum, media coverage, and retail participation all at once. And by that stage, the early advantage is already gone. For silver specifically, this phase can become even more aggressive. Unlike gold, which primarily reflects monetary confidence, silver sits at the intersection of two worlds, industrial demand and financial speculation. That dual role makes it more sensitive to supply constraints, manufacturing cycles, and sudden shifts in investor sentiment. When pressure builds from both sides at the same time, silver doesn't just trend, it accelerates. And historically, those acceleration phases don't move slowly. They move in sharp, almost explosive waves that catch late participants off guard. At the same time, gold tends to behave differently. It doesn't chase momentum, it anchors it. When uncertainty deepens, gold becomes the reference point for stability in a system that starts to feel less predictable. And this is why its movements matter even when they appear less dramatic on the surface. A steady, persistent rise in gold during periods of supposed stability is not normal behavior. It's a signal that underlying confidence in currency systems may be quietly weakening, even if official narratives suggest otherwise. Now, connect these two dynamics together, gold steadily strengthening, silver preparing for potential acceleration, and place them inside a global system already dealing with high debt, fragile liquidity, and limited policy flexibility. What you get is not a guaranteed crisis, but a highly sensitive environment where even a small trigger can create disproportionate reactions. That trigger could come from anywhere: a credit event, a liquidity squeeze, a geopolitical shift, or even a policy mistake. The exact source is unpredictable, but the setup is what matters. And this is where awareness becomes more valuable than prediction. Because no one can time these shifts perfectly, but recognizing the structure before it fully unfolds changes how you respond to it. It changes how you interpret market movements, how you evaluate risk, and how you position yourself in a system that is no longer behaving in a simple, linear way. And right now, the structure being built beneath gold and silver is not random. It is layered, it is consistent, and it is pointing toward a phase that demands attention before it demands reaction. And if you bring this back to the real world, not charts, not theories, but everyday life, the implications become even more important. Because financial shifts don't stay inside markets, they spill into everything. The cost of living, the value of savings, job stability, borrowing conditions, and long-term security. When underlying financial structures begin to adjust, the effects don't show up all at once, but they build quietly until people start to feel them in ways they can't ignore. And by that time, reacting becomes much harder than preparing early. This is why signals from gold and silver matter far beyond traders and analysts. They matter for anyone trying to protect purchasing power, understand where the economy might be heading, and avoid being caught off guard by changes that seem sudden but were actually building for months or even years. Because markets don't create reality, they reflect it. And right now, what they are reflecting is not collapse, but imbalance. And imbalance, by its nature, always moves toward correction. But here's the part most people miss. Not every correction looks like a crash. Some unfold slowly through currency devaluation, rising costs, and shifting opportunity landscapes. Others happen faster through sharper pricing events that force rapid adjustments. The outcome can vary, but the warning phase often looks very similar. Subtle shifts, unusual behavior, signals that don't align with the official narrative. And that is exactly the phase we appear to be in right now. So the real question is not whether gold will go higher or silver will break out tomorrow. The real question is whether you are paying attention to what their behavior is telling you about the system as a whole. Because by the time a trend becomes obvious, it is no longer early. And in financial cycles, being early is not about speed, it's about awareness. It's about recognizing patterns when they are still quiet, when they still look uncertain, and when most people are still comfortable ignoring them. If you want to stay ahead of these shifts, understand the signals before they become headlines, and break down what's really happening inside the financial system in a way that actually makes sense, make sure you're subscribed to Metal Market Insight. Because here we don't just follow the noise, we follow the patterns behind it. And as always, this content is for informational purposes only, not financial advice. Do your own research, stay aware, and remember, in every financial cycle, the warning signs are always there. But only for those who know where to look.